Your money is sitting in a bank account right now, quietly earning almost nothing, and the bank is absolutely loving you for it. While you collect a fraction of a percent, the same institution is lending your dollars out at rates that would make your jaw drop. Let's talk about the national average savings rate, which is sitting at around 0.38%. That is not a typo, and no, we are not joking. Meanwhile, some high-yield savings accounts are offering up to 5% APY right now, which means the gap between what most people earn and what they times earn is not a rounding error, it is a lifestyle difference. Here is the catalyst. The Federal Reserve spent years hiking interest rates to fight inflation, and when rates go up, savings yields follow, at least for the banks willing to pass those gains on to you. Traditional brick-and-mortar banks, with their marble lobbies and their $17 parking validation, quietly kept your rate near zero while pocketing the difference. Online banks flip that model entirely because they have no branches to maintain, no free lollipops at the teller window, and no overhead bloated empire to fund. Companies like Varo Money, Axos, Newtek, and Wealthfront started offering rates like 5%, 4.21%, 4.20% real numbers tracked daily by firms like Carino's because their cost structure actually allows it. Now, not long ago, the financial media was buzzing about high-yield accounts like they were the hottest thing since index funds, and everyone was rushing to open one. But here's the uncomfortable truth. Rates are not guaranteed to stay this high. And if the Federal Reserve starts cutting, those beautiful yields will begin to quietly shrink like a wool sweater in a hot dryer. That psychological whiplash from excitement to anxiety is something investors across every asset class know well, and savings accounts are not immune to it. Economists and commentators are split on how quickly the Fed will move, but the market is already pricing in cuts, which means the 5% window may be closing faster than you think. History tells us that these high-rate environments are cyclical, not permanent, and every generation gets one or two windows where cash actually pays you something real. We saw in the early 2000s, we saw echoes of it before the 2008 crash, and now here we are again, a moment that feels unique but rhymes with everything that came before. The misconception we need to address head-on is that high-yield savings accounts are somehow risky or complicated. They are not. These accounts carry FDIC or NCUA insurance protection up to $250,000, have low or no minimums, charge no monthly fees, and keep your money fully liquid so you can access it whenever you need it. The one thing people often overlook is that the interest you earn is taxable. So when you are modeling your real return, you need to factor in your tax bracket alongside inflation, which can still quietly erode your purchasing power even when the nominal rate looks strong. A 5% return in a 4% inflation environment is still a real gain, just a more modest one than the headline suggests. The practical lesson here is not complicated. If you have an emergency fund, short-term savings, or cash you are parking before deploying into investments, there is virtually no rational argument for leaving it in a traditional account earning 0.38%. Look for strong APY, no fees, easy access, and FDIC insurance. That is the checklist, and it is not a long one. If you want to go a step further and you can commit to locking your money away for a set period, certificates of deposit may offer even better rates, but you trade liquidity for yield, and that trade-off has to match your actual timeline and needs. The disciplined move is not chasing the absolute highest rate. It is matching the right account type to the right purpose with the right time horizon. Philosophically, personal finance is rarely about finding the perfect instrument. It is about not leaving obvious, easy money on the table while you wait for perfect conditions that never arrive. Consistency, sizing your decisions appropriately, and removing emotion from the process will always outperform the person who waits for certainty before acting. And honestly, whether rates rise, fall, or hold steady from here, the move to a high-yield account is one of the lowest risk, highest clarity financial decisions available to almost anyone right now. Rational preparation is not about predicting what the Fed will do next. It is about positioning yourself so that whatever happens, you are not the one quietly funding someone else's marble lobby. We live in an era where information about better options is completely free, and switching accounts takes less than 15 minutes. The only thing standing between you and materially more interest income is inertia. Break the inertia, make the move, and let your emergency fund actually earn its keep while it sits there waiting to be needed. And if you are ready to take the next step beyond just saving, whether that means getting into real estate investing, tackling a home contracting project, or connecting with the right lenders, we can help you get started. So check out our links in the description below.